Next week we have PPI, and then February 1, we have an FOMC. As can sometimes happen, yesterday got so hyped up from everybody out there that it could possibly potentially be this real big, massive move that we ended up with no move at all, really. And we're right back into the thick of it, still working to get out of the zone or the range. Tesla down again. Airlines also. And we do have a couple of Fed speakers. They're running out of time. They'll go into a blackout mode as we get a little closer to the February timeframe. There's a holiday next week, so it'll be a shortened week. Volumes within normal ranges again, which makes sense, right? We were waiting on the CPI. We got the CPI, and now things are calmed down. Sitting back inside day again. We're now still going to be focused on getting out of this range. We at least have an IX10 expansion at this point. But that doesn't carry us very far, considering we still have that 40-50 to get through. Unless something shows up on the docket today, something that can galvanize us out of this range, we're looking for a change in the narrative. We're looking for a change in the storyline, right? We need something to resolve this issue where the Fed continues to say that they're going to hold rates high and not back down at all in 2023. And the bond market and the rest of the market seems to think that the Fed is going to have to pause, pivot, start turning back before the end of the year. It's one of those two needs to dominate. And until then, we're going to continue to see this nothing market where we just chop and chew everybody up. We do have a market maker move this morning. It's around $25, and we already had an ADR of 1.8, which is around $75. So you put those two together, we have the potential today to make around a $100 move. That seems a little light, right? If we add those together, it comes up to around 2.5%. It's not bad, but we've seen, some 3% moves in the last 12 months. And I would again do just like we did yesterday and measure out what that 3% move would look like. on the off chance that we finally do start to expand, to have an idea of just how far exactly we would go. So a 3% move gets us right around 40.20. Do the same thing the other direction, and that gets us down to the weekly pivot point. Now, when we're above that weekly pivot point, we consider the market in a bullish bias. We want to look for long trades. We want to look for long continuations. Until the point, obviously, when we begin just dumping back through the levels and begin targeting a move back to the weekly pivot. But as long as we're above it, kind of like with this daily pivot back here when we had that MDP, as long as we were maintaining our move farther away from it, we just kept our bullish bias. But when everything started to fall apart, that became the target of what we were looking for. So as long as we maintain this move and we can hold away from this pivot point, then we're going to keep our bullish bias. But if it starts to unravel and begins to tip the scales in the other direction, that's going to become our target, 38.85. There is a bright note to all of this. We did finally get out of this range. It just left us sitting in this range. So we had a lot of divergence in our tools yesterday. You can see here with the advancing and declining issues in the S&P that they just rolled over. And in the NASDAQ, they never really reclaimed much above the zero line before coming back down into it. And yet in the breadth, in the cumulative ticks, they continued to expand all day long. And for those that are learning to kind of get familiar with this thing, there was a signal in here that was solid and strong all day. It was the leader, the green line, staying above the crowd and leading everything above that crowd. It would be more of a choppy, grindy sort of situation if the green line stayed in between these two, like a channel. Takes a while to get familiar with this cumulative tick. Then the reasonably decent move that we had to the upside yesterday was that KRE breakout, which coincided with the NY Fang breakout, and then the same thing on the sell-off. Earlier in the day, we had a huge differential between these two. So it kind of highlights how when they work in sync together, the market can really move. But if these two aren't working together, you get a whole lot of chop and kind of a market that's fighting itself. That is awesome. One thing that we really want to keep our eye on is the 50% mark. It's sitting at 39.20, and it's basically the low from last Friday and the high from yesterday. That would be the 50% mark of those two. And it's still above the weekly pivot, so it would help us maintain that bullish bias and the expectation that the market's going to continue to move upwards. But there is the other side of that coin too. When we talk about Fibonacci's, I use a 786 a lot. Now we can wick down below, and drop back up again through it. We just can't close below it. And that's a little bit of a benchmark for me, a line in the sand. If this trend is still intact, it shouldn't pull back more than that 786, and it shouldn't close below that 786. So if we're going to look for a continuation next week, that's a little bit of a benchmark that I want to keep, in plain sight. Now we do have a little bit of an expectation of a Busby. We were in a range. We finally broke out of that range. We could come back down and test that range. Validate a new support from an old resistance. We could, and that wouldn't invalidate something like the Fibonacci's or anything like that. I haven't had time yet to parse through the article, but there's something going on January 17th coming out of the Bank of Japan that's very likely going to be impactful. I'll know more about it over the weekend. It's been a busy week. I haven't had a chance to get to it yet, but they've put out statements. They've basically put out a warning, and we want to be prepared next week for some shenanigans. If we were to pull back to October, which we might as well just. We had 4 months of sitting in this range. It's 500 points wide. I've got a whole lot of running around and nothing done. We're building a significant base down here, and basing is really important, right? If you look back at, your rounding patterns, coming off the lows, turning around and heading back up again, building this base is important. And since it's part of a base, we could revisit that 3,600. So don't think that that's off the table, or that we couldn't go even lower than that and say get down to that 35. It would still be just this idea that we're basically done going down, and we're trying to stabilize and build out from here and finally turn this ship around and begin going back up again. It's the classic accumulation distribution pattern, right? Old school Wyckoff stuff. But it takes time. We're on a weekly chart. We've been in this thing for 4 months already. And it's very likely going to be, another month or two before it finally stabilizes. I've seen a lot of really smart analysts who say we're going to be out of this mess by the end of the year, out of this bearish market mess. We've seen a lot of signs of the inflation abating, right? We've had consistent, persistent readings of lower inflationary values. Maybe it's done, maybe not. Maybe the Fed cracks the economy, right? Put some holes in it. But this stabilization here of holding within this zone or this range is kind of a good thing if we can just stay patient and hold through it, right? It's not. I couldn't get the live stream to go out onto YouTube this morning. It kept giving me an oversize error, whatever the hell that is. So no live stream this morning. It's still got the error. There's the error right there. Wouldn't go. I don't know. So we're pretty light on the economic agenda today, other than the Fed speakers. The rig count is not likely to cause any sort of an issue. So once we're done with consumer sentiment at 10 a.m., we're basically free to go for our 0 day. Keep in mind that on a Friday, 0 days can be a lot more than just the SPX, right? But that doesn't mean you necessarily want to do one. Stay on the sell side or it's not a 0 day, right? As a strategy, the 0 day uses the sell side. Obviously, if you're trading options that have 0 days to expiration, it is a 0 day, but you wouldn't want to buy 0 day options, right? That's not the plan. You don't get any edge or benefit from that. It's all handicap if you do that. If you're going to buy options, go at least one strike out. One strike, one series. Yeah, series is the word I'm looking for. As you can see, Monday we're closed. Tuesday is the 17th. Go out at least that far if you're going to just buy a call or buy a put. $10-day, 30-minute volume profile. This thing is trashed at this point. We're supposed to have a classic shape, right? Like a capital letter D, a capital letter P, a capital letter B, a lower B. We don't have any of those. We've just got these massive spikes with relatively shallow zones in between each one. These are not support and resistance. They're more of goalposts and areas of concern. So the peak from Monday, that Monday's high area, we've got some liquidity there. Could get a first touch bounce or first touch play there. If we break through it, things get shallow again. That takes us down to 39.20, where we end up with another volume shelf around that 39.20, 39.10 cog line. Drop through that. The pivot point at 38.90 is worthless. If you look left and you see this pivot point here that has no value to it, not even a first touch play, should punch right through that without any issues. And that would get us down into the 38.80 area, 38.70. So pretty worthless, really. And that's what's happened from just hanging out in this zone with these spikes and accumulated areas. We still have 2 VPOCs underneath us. It's unlikely that we're going to reach either one of those today unless we do expand that 3%. And the only reason that we have 3% as a move today, as a potential move today, is because we have that market maker move on the table. Something is going on where the front end of the curve is getting a lot more volatility than the next series out. Even when we don't know what that is, we can see the effects of it. We can see the warning that is coming at us. We're about 2% away from the 10-week moving average. So we're not overbought yet, but we're working in that direction. Overbought would be at least another 1%, right? We start getting around 3, maybe 3.5% away from the 10-week. We would start to consider being overbought, but we're not there yet. So we are slightly past the 10, but not enough to be concerning. And then the 10-day, we are 2% away from the 10-day. It's a little overbought, not enough to make us think it has to pause. Closer to 3% fits that mold for being overbought. So we're not quite overbought, but we're getting close. We are outside the weekly expected move, at least the one drawn by the machine, right? Like I continue to state, if you draw them by hand right now, you're going to notice an exaggerated difference between your hand drawn lines and this little indicator's hand drawn lines. One thing that I've been doing for just a little bit of a rough estimate is I added one more deviation, right? So from here to here, that's a 1 standard deviation. From here to here, that's a 2 standard deviation. And that 2 standard deviation actually lines up closer to where the hand-drawn lines would be. So 40-50 to the upside and 38-20 to the downside. That is the range for this week that we've been in. We don't have next week's because I'm looking at the SPX. But if we put the ES back in here, it will already show us next week's range. Now remember, that range isn't set in stone yet. It won't be locked in until the end of the day today. And it's a 4-day trading week next week. So when we look at how big the range is and compare it to this week, keep in mind that it's a shorter week next week. And I'd say we're coming up a little light. So here's the range for the week that we were just in versus where we're going to be next week. We have the 50-week moving average at 40-20. Basically, it's 40-18, 40-20. It's right over our head. In fact, we hit it this week and we rejected off of it. If we make a move back up, right now it's going to be a focus on getting outside of the week that we're in, the high that we've set on the week, which would be 40-21. If we can do that, we would not only be expanding beyond this 50-period moving average, but we would close the week in a fully expanded green candle, right? That's this breakout candle that we have here. There is another 50 over our head, right? I don't try to make a distinction between should I use the EMA, should I use the SMA. When it comes to the 50, the 100, the 200, I just use them both. I use the EMA and I use the SMA. That would be at 40-50. The smaller moving averages, they're all clustered underneath this. And then we have the 200 period down at around 3,700. We're not going to make it to that distance today. Not even likely going to make it there this week. Next week, I mean. Now on the daily, we're messing with this 200 period. It's what we're tangled up in right now, and it's both of them. It's the EMA, it's the SMA. It's right there. If we can get above this, we'll be starting into the new year, the first month, and right into the earnings season in the first quarter, and we will be above the 200 period moving average. Now, health-wise, the market still has a long ways to go. The 50 needs to get back above the 200, right? So as long as the 50 is under the 200, this isn't a solid long-term trend with structure and strength in it. We have to get that 50, but everything one stage at a time. And I'm taking the time to point all this out this morning because if you're still maintaining a very strong bearish bias, you might want to dial that back in your portfolio. Right? I was talking to a couple of well, I don't want to call them traders, a couple of people yesterday who are, trying to trade. They're trying to, keep a grip on all this. They're heavily bearish because they finally got convinced somewhere, around August last year that the market's going to continue to go down. And now they've got a whole lot of shorts on. Might want to dial it back a little bit. I'm not saying that we can't go down some more, but everything that caused this economic downturn and put us in a bearish marketplace is slowly being eliminated, right? We're working through all of it. There's not a whole lot left. One of them, technical analysis wise, will be getting above and staying above this 200 period moving average. And I don't care which one you use, just pick one or do what I do and use them both. I think it's time for a change of tune. I really do. I'm not saying we shouldn't still be a little bearish, right? A little bearish, but I was taught to be long when the market is short, and I was taught to be short when the market is long, because we can never call a top and we can never call a bottom, and we need to be prepared for a market to dump. So back in February of 2000, when COVID hit, I was net short, even though we were sitting at the highs. Not net short, but I was carrying shorts. And when we topped out right before 2022, I was still carrying shorts. It's a tricky thing to stay net, to carry a negative position in a bullish market, right? Through all of this, I was short, carrying shorts through all of that. And profitable. You can carry shorts even when the market doesn't go down and still make money on them, right? That's the beauty of options. Most of my positions were long because we were in a bullish market. Of course, I want to be long, but I carried shorts in that. We need to start carrying some longs in here, right? With me being zoomed out like this, that purple line really stands out. If we get above that purple line again, like we did back here, it took a while, right? We got up to it, we chopped around and we crisscrossed through it a few times, but then we finally got above that sucker. And then, you get a test or two, maybe a Busby, and we start working on maintaining a move above that 200. So there are some signs, right? That's the great word. It's a perfect word. There are some signs that we need to be a little bit cautious and not be full portfolio net short in our positions. Carry some longs. Even just start nibbling around the edges, small stuff. What's the small stuff right now? Well, it actually is small stuff. Macro cap and micro cap, the Russell, smaller names. Now, I don't trade those kind of names, so that really doesn't excite me yet. But we start getting into some mid cap, yeah, that I'll be a lot more interested in. So just, a little bit of a step back, take a look around and realize we do have a lot of reasons to be bearish. Yeah, it's really crowded because like mid-year last year, everybody finally got convinced that we were going down. And those same people who were late to the party by 6 months, they're going to be the same late people who are late to the party on the rally back out. I'm already carrying longs in Netflix and Meta. And there's some capital rotation going on, you know, with healthcare still kind of weakening out. And I mean, there's opportunities out there. I'm just pointing it out because every place I go, everybody's super bullish, except for JC Perez. He's not bullish. He's not bearish at all. He's bullish. But most places, and stockcharts.com, Tom Bowley, I know I'm screwing his name up. He's started to get a little bullish too. Right. So, but otherwise, the more I look around out there, everybody's bearish, heavy bearish. And I'm so tired of hearing about semiconductors being the next greatest short. If they haven't gone now, with those beautiful inverse head and shoulders on Taiwan Semiconductors and NVIDIA, right? I'm sure that there's still got some weakness that they could still kind of chop around, that they're not going to just come right back up again. But even though they didn't fall out sector-wise like the rest of the sectors did, that's not a good enough reason to maintain a short. And that's been the whole argument. Oh, well, this hasn't fallen as much as everything else. Let's short this. You know, that argument only gets you so far until things don't fall. Like Caterpillar. There's some really, really smart people that are short Caterpillar right now. I'm not. I guess I'm not smart enough. Their argument is, well, everything else has fallen and this hasn't, so let's short it. If that's all you got, that's a pretty weak argument, right? And you get traders like Corey Rosenblum, who's, you know, he's a pretty smart guy. He's wrote a couple books. He would look at something like this and say strength begets strength. And as long as this stays strong, it's going to attract more investors and they're going to buy into it and they're going to buy into it and bring other investors in to buy more of it. So, you know, strength begets strength. However, this is connected to energy, right? So if energy stays soft and squishy and weak, this will still stay strong. But if energy starts rallying up hard and strong, then this is likely going to head to the downside a little bit. I'm not ready to say semis long, but I'm certainly not semis short. Some neutral plays, maybe some bearish or bullish neutral plays. I could see something like that. I wouldn't buy calls. That would actually need a directional push, and we've just had a good one. But I'm not looking at these thinking, oh, that's a great short. Healthcare, it looked like they were rotating out of healthcare. And I mean, I'm short, you know, like Humana and a couple others. You got to look at the ETF flows, and we're waiting. Well, I'm waiting for the data from December, right? So the ETF flows will help out a lot. First month, right? So January's got to end, and we've got to see January's numbers to really get an idea. Just looking at the charts isn't going to give us enough, right? We want to see where that money flow is. And this is like the buying spree, right, for the new year. The firms do it all the time. Buying spree, selling spree, whichever direction they're going to run on the year. I think it's buying. But we got to see those ETF numbers, right? So we'll know more in the first week of February about the capital rotation. But energy pushing back up. Healthcare had that triple top and starting to fall down. We might be finally rotating out of healthcare. Those defensive names, right? If the move is back towards a market that's going to recover, then we got to expect that those defensive names are not going to do so good anymore. So cereal, food, healthcare, utilities, we're going to expect those to start to weaken back out again. And then it's going to be more of the consumer discretionary, casinos, cruise lines, resort hotels, of course, tech, maybe not the mega market cap tech, right? Because mega market cap is still got a long ways to go. But small cap, mid cap, even large cap tech, we're going to expect to see a lot of those service names continue to do good, right? China is reopening more people moving around, using services, using goods. People bought their fancy computers, they bought all their electronic toys, they worked on their home. Now they're just ready to go out and, take vacations, get away from it all. Service industry. We do have banks kicking off today. KRE is down significantly from where it closed. XLF, which is more of a broad-based financial, is also down from where we closed at around 36, or I should say from the high of the Globex last night, the after hours. So far, the banks aren't doing too good. Now, I've been stressing on this for a while. I've enjoyed trading finance and energy as a day trade a lot last year. They're small, they're liquid, right? You can be nimble in there, get some great trades. But it's kept me focused on finance way more than I normally would be. And the distinction between finance, or what I use, KRE, and the NY Fang, when these two are divergent and they're not working together, we end up with a harder trading day in the S&P. But when they're working together and they're both moving in the same direction, we get a really amazing trading day, up or down. It doesn't even matter. I don't care which way we go. This has been a part of a little bit of a rotation, right? And it's been tech versus finance. So we'll see finance do good and tech falls, and then everything will swap midday and tech will run and finance will fall. So it's been this either or dichotomy. Today, if we're talking about a 3% move in the market, it's only going to come if these two work together. And that might be to the downside, right? So if tech starts to dump today and joins finance, we could have one hell of a move to the downside. If finance is doing like a little bit of a fake breakout, right? This pre-market weakness where it turns around and rallies back out again and joins tech for a move up, it could be one heck of a rally to the upside. The only reason, remember, the only reason we think there's a 3% move even possible today is because we have a market maker move on deck. That does not show up for nothing. And when we have a market maker move, it is a signal, it is a warning that they see something out there, right? Traders are pricing in the front end, and we've got a higher volatility in the front than we do in the next series out. So I like this because it's not my bias that says, oh, we could make a big move today. It's the numbers that says we can make a big move today. And we've already made it to the first ADR. We don't really have a lot that are doing good. Everything is negative. Now in a high correlation coefficient, we don't have to be stock pickers, right? If everything's going down, anything you throw a dart at is going to be going down. So we want to ask the question, how many names in the S&P are going down and are down more than 0.5%? 48. We can round up and say 50. Half of the S&P is down this morning more than 0.5%. So we could look for outliers and say, okay, well, which one of those aren't down and have actually made an upside move this morning? Energy, Caterpillar, Bank of New York Mellon, BlackRock. So 4 finance names, 3 finance names, and energy and some manufacturing. Names in the S&P that are down more than 1% this morning. There's 25, so 25% of the S&P is down more than 1%, and it's finance, right? Lots and lots of finance. Sure, there's others in there too. We got some electronic technology, consumer durables, Ford, Tesla, GM, the automakers, MasterCard, Citigroup, of course, Goldman, JP Morgan, American Express, Schwab, some health services, UNH, Facebook, Amazon, the monsters of tech are in there too. So not focused in one spot, right? Sure, it's finance, but it's taking everything with it. For the NASDAQ, 42% of the NASDAQ is down 0.5% this morning. It really looks like Tesla is leading the way to the downside too. A lot of those EV makers, Rivian, Lucid, and 20% of the NASDAQ is down more than 1% this morning. And it's the big names, NVIDIA, Amazon, Facebook. Those are monsters of tech names. Tesla. So there's only like 8 monsters of tech, and more than half of them are down more than 1% this morning. It continues to drive that narrative that mega market cap names are still churning and moving to the downside, but small cap, micro cap, and even a little bit of large cap are already based. They've built their base, they've bottomed out, and they've curled over and have started working their way back up again, because they were the earliest bubbles to pop back in 2001. That just about sums it up right there. So a little bit in the utilities, processing, transportation, producer manufacturing, that's your green sector. Everything else is either neutral or just beginning to really get negative. Now it's in the S&P. We flip that over to the NASDAQ. Not much different there. Now, K-Web is positive this morning, not by much, but it is positive. So if we're going to see, a continuation there, it'll more than likely be those names that are still coming around, right? The casinos, like resort hotels, casinos like Las Vegas Sands and things like that. Maybe some of the airlines still. And we do have yields this morning turning. Let's see what's up with bonds and we can wrap it up. Yeah, bonds aren't doing that bad compared to the S&P. Still going to be watching for a decouple here with these two, right? We've had stocks and bonds kind of working in the same direction together. That's not going to stick, right? One of those two are finally going to break away at some point. It's more likely to be bonds that make the overture that starts to break away. Hard to argue, but the bonds look like the better play. Certainly an easier trade than, and easy is not a good word to use, but either way. Keep your eye on the split between these two, between New York FANG and KRE this morning. That's going to be your greatest tell. Watch the clock. Everybody have a good weekend. Hopefully I'll get the streaming problem fixed and we'll be back up and running normal again on Monday. Have a good weekend. I'll see you all on Tuesday, not Monday.